Welcome to the Health Daily Show, your go-to where leaders, founders, investors share insights on growth, innovation, business building. I'm Chitra Navid. Joining us today is Navid Farzad, partner, Frist Cressey Ventures. Navid, welcome. Thank you for joining us.
Thank you, Chitra. Excited to be here.
Frist Cressey, born right here in Nashville. Tell us, what's unique about the firm and your investing approach?
Yes, indeed. Born here in Nashville. We're experiencing a home game here with Vive, so we're excited to have them in town. And we're a healthcare venture capital firm founded by Senator Bill Frist and Frist Cressey not that long ago. So we're relatively young, although the principals have been doing this, all of us, for a number of years, very long time, and decades in some cases. We are deeply kind of oriented around a mission, which is transforming healthcare to improve lives. And if you think about Senator Frist and Brian and the founding of the firm, they didn't start the firm to have something new to do or for a new job, right? It was done really to drive impact. And they've been, to collect all the experiences and everything that they have and give back into the industry. And truly, we take it really seriously to really impact lives.
Are there certain areas that you focus on?
Do. So sometimes you just say, well, we don't do. So we don't spend time in pharma, life sciences, biotech, medtech. So everything we're doing is in the broadly services sector. And we're investing in software, technology, tech-enabled services, and primarily, not always, but primarily with an end market of payer and provider.
It's a challenging macroeconomic environment. Recessionary, inflation, job cuts, bank failures, Silicon Valley Bank, Signature Bank. Several VCs, including the big brand funds, have made significant portfolio write-downs, especially investments made over the last 3 years. Roughly 90 health tech unicorns have had their valuations pulled down more than 30% last year, with more hits coming this year. What's happening in this industry and why?
Yeah, it's kind of an unprecedented time, and everything's happened relatively quickly. But I'd say you got to really look at why we're here. And I think that supply and demand forces drive so many things in business, of course, but also just in life. And there was an over supply of capital and too much liquidity. And if you have all this capital here, it needs a place to go. And so then the phenomenon is you've got more companies that are founded and funded, and you have existing companies that are raising more capital more quickly, that there's and then at the same time you have this backdrop in the market with a really strong stock market and public markets. You had the stimulus from COVID, and then all this liquidity, and so it was relatively easy for folks to continue to justify higher valuations, and then it stopped, and it started with the correction in the public markets. Massively higher interest rates in such a short period of time. We were in zero interest rate environment. And so, it needs to correct, and it's happening. There's more work to do. And here we are. I think it's, net healthy. And, we were in a kind of a unsustainable place.
What's happening then in your firm? How does the experience flow through to your firm in terms of if and where you're deploying capital, at what velocity, as well as the valuations of your portfolio companies and being impacted by write-downs?
Absolutely. First, I'll say it impacts everybody, right? I mean, no one's immune to this, but it does impact folks at different levels based on stage, and just the activity and how disciplined or not you were through the last handful of years. We're impacted, right? We've got, when the equity markets go down, our comps go down, and so our valuations go down from an enterprise value perspective in our companies. However, I'd say, we're fortunate that net across our portfolio and across all of our funds, we're up year over year over the last 2 years, each of those last 2 years. So not without, a lot of, just activity within the portfolio, making sure things are shored up, making sure there's enough capital and capitalization is appropriate. But we feel fortunate.
Given some of these elements that you talked about on the portfolio write-downs, there was already a chilling of investors deploying capital and founders turning more to venture debt. With the Silicon Valley Bank collapse, what's your outlook on venture investing versus venture debt?
So, I think I come from originally, I started my career in investing years ago in private equity. And there's a big difference between private equity and the dependence on leverage to, in some cases, the dependence on leverage and the leverage markets being open to even get deals done and get the underwriting to fit. With us, it's more of a, and there's situations where you really need it, but they're in the minority. So it's really more of a nice to have than a must have for us to be able to deploy capital. Most of the time, almost all the time, we're deploying capital initially, and it's all equity. And then at the appropriate time, there's opportunities to leverage venture debt to kind of juice returns and create longer runway, but it's not a necessity. So we can withstand this period of time and not have to go to the venture debt markets because I do think they're going to be disrupted for a while here. Now, if it's prolonged years and there's talk of a credit crunch, if we're down that road, everyone's going to be impacted and to a higher degree.
Let's talk about the venture capital industry and this notion of concentration versus democratization. There's research and many experts say that there are about 3,000 VC firms managing over $1 trillion in assets under management. And of this, there are about 1,000 firms or individuals that are significant, quote unquote, and have the lion's share. It's a tight social network. These folks follow each other on Twitter, LinkedIn, text. Experts say this is dangerous because that tight group caused the SVB bank run. Mm-hmm. What are the pros and cons of this notion of concentration versus democratization in the VC industry?
Yeah, so there are certainly pros and cons. And on the pro side, we have in nearly every investment a syndicate, right? And we're investing with others. And going back to our mission of improving lives, we really want to have as much of an impact on as many people as we can. And we certainly can't do that ourselves, right? And so we have a tremendous amount of respect for our friends and others in the industry that we co-invest with. And with them, as we tackle problems that a company or the problems that a company is addressing together, we can really just do more, right? And improve our industry more and more quickly. So from that perspective, having a tighter knit community where there's trust and continuity really helps. And it helps kind of truncate the amount of time that it takes to get into a business and work together as a collaborative of investors. On the other side of that, I think we're an industry, and this is private equity and venture capital and probably financial services broadly, where there's so much groupthink. And that's not healthy where things tend to just move together. And there's a tendency also for them to move and over, to the up and the down, overcorrect or whatever it is. And so that's a phenomenon. And that's part of like the underlying reason for the SVB situation, right? I mean, it was a situation that was there and an opportunity for this to happen, right? Which, was the macroeconomic environment, and there was that smoldering foundation. And then there were the bad decisions that were made at a senior management level. However, those tens of thousands of people were just heads down doing great work. We have a lot of friends at SVB. It's really unfortunate that this occurred, and so that it's a but it is that that quick tweet or text or so and so's withdrawing all their capital from SVB, and the fear and the fear is pinned to this kind of uncertainty in the economic environment, and then you have a digital bank run.
So what's your message then to VCs, to your VC fraternity on that front?
Yeah, I think, and I'm speaking for ourselves and everyone, is that, just we need to just, really think independently, collaborate, right? Because, thinking together is healthy and necessary, but not just move as a herd, right?
VC funding has sunk more than 60% from highs 2 years ago. It's taking VCs longer to raise less money. What's your advice to LPs that still want to be in this asset class?
I think it should be refreshing for LPs, and I think that the message to them is, you can now kind of really, the pace is appropriate, and you can take a step back and really spend time with managers, get to know them, and really think about what's best in terms of your deployment of capital and allocation across different managers, and it should be a an opportunity for them to really have another, card turnover, another data point, right? To look at funds and managers and look at, what they did or didn't do over the last 2 or 3 years in this environment that we're coming out of, and say, is that someone that I want to either continue to invest with or make a new commitment to?
Take us into your investor pattern recognition. There's many founders companies out there, many at this conference, who are pitching, wanting to get that check from you. What are those specific attributes, metrics, characteristics in your pattern recognition that motivates, inspires you to make that investment?
Yeah, it's all about the leadership, right? And we've got just a simple way that I think about, where we invest or don't. And what we're looking for are great, passionate leaders who are, in a big part of the industry, so a big market, a big sector, solving a big problem, and solving a problem that people care about, right? Because ultimately, someone's got to buy what you're selling. And that's not always the case, right? So whether you're too early to market or all the other reasons, they've got bigger fish to fry, it may not be right. But exceptional leadership, big market, big problem, people care. When those things come together, we get really interested. Now, that first one, outstanding leadership, is hard. It's hard to, so many times, more times than not, we're backing first-time founders, first-time CEOs, I should say. And it's, it's in a short period of time with limited touch points to make that determination. And we're really looking for people that, really have that fire in here, right? It's not just a job, going back to kind of our mission, right? And there's an alignment there. It's not just a job. They really want to move the needle and have an impact and leave a legacy. And they realize it's going to be really hard.
Navid, thank you so much for joining us.
Thank you, Chitra. Appreciate it.